Let's discuss the pilot paper of the subject Advanced Corporate Reporting issued by CASriLanka, focusing on June 2026 examination, right? So here, if you look at the paper structure, there are two sections, section A and section B. Section A, one question, which is a compulsory question, 50 marks question. Right? In section B, you have 3 questions. Out of that, in the exam, you need to answer for 2 questions, 25 marks each, 2 questions, altogether 50 marks again. Right? Right. So, now what we can do is we'll look at the question number 1 first. Right? We'll look at the question number 1 first, which is 50 marks question. So, if we start reading the question, right, what it says is Vanguard Global PLC, VGP, right, VGP is a publicly listed diversified conglomerate, headquarters in Sri Lanka, right? So this is a diversified conglomerate where the headquarters are located in Sri Lanka, with operations spanning advanced manufacturing, logistic technology, renewable energy solutions, and digital infrastructure services. They have diversified businesses. Okay. The group's board has articulated a strategic agenda focused on portfolio agility, capital discipline, and sustainability linked access to funding, while managing increasing regulatory and geopolitical uncertainty. So the board's agenda is given here. So for the year ended 31st March 2025, this is our financial year, the Audit and the Sustainability Committee has requested an integrated assessment of several complex transactions and reporting judgments that may materially affect the group's consolidated financial statements and the strategic disclosures. So the Audit and the Sustainability Committee. Seems that sustainability aspect, sustainability reporting aspect is also overlooked by the Audit Committee. So this particular committee requested an assessment of several complex transactions that would affect the group's consolidated statement of consolidated financial statements and also for the disclosures to be made. So what we can do is, right here, so you have been given number of transactions. So then you need to answer to the questions raised at the end of the information. So what we can do is, before reading the first part of the question, let's look at the requirement, because by looking at the requirement at the time of reading the question, we can plan the answer, right? Always look at the requirement. So what is the requirement here? What examiner wants us to actually answer is a bit of a lengthy question. So part A, assess the appropriate accounting treatment of 𝐒𝐫𝐽𝐷, including held for sale classification, measurement and impairment implications as at 31st March 2025. So what is to be looked at? What is the appropriate accounting treatment for 𝐒𝐫𝐽𝐷, including what? Held for sale, classification, measurement and impairment implications as at 31st March 2025. Seems that we need to apply SLFRS 5, non-current asset held for sale and discontinued operation. So you have to explain the accounting implications, including what is mentioned in that particular standard. Your answer should include both initial and year-end accounting treatment, initial and subsequent measurement, right? Initial and year-end accounting treatment with relevant computations. If there are any computations to be done, that also to be included as a part of the answer. Right. So by looking at this requirement, so now let's read the question, then we can plan the answer while we are reading it. Right. So let's go to the question now. So company is what? Vanguard Global PLC. So you have to answer from that particular perspective. That particular company, VGP, has entered into certain transactions with some other companies. So you have to explain how to do the accounting in terms of the transactions that are carried out by VGP. Right. So the first transaction is subsidiary acquired exclusively with a view to subsequent disposal. So the particular subsidiary that was acquired exclusively with a view to resale is what? 𝐒𝐫𝐽𝐷 Private Limited or 𝐒𝐫𝐽𝐷. So this particular company, it was mentioned in the heading itself, which was acquired what? Exclusively with a view to subsequent disposal. So you are acquiring a subsidiary with the intention of disposal at the time of acquisition itself. What it says? On 1st October 2024. So our year end is 31st March 2025. So that means this acquisition has been taken place 6 months before the year end. VGP acquired 100% of equity shares of 𝐒𝐫𝐽𝐷 for a cash consideration of 2.4 billion. Right. So what is the consideration? 2.4 billion to acquire 100% equity share capital of 𝐒𝐫𝐽𝐷. 𝐒𝐫𝐽𝐷 is a specialist manufacturer of commercial and surveillance drones with export-oriented operations. So they are a drone manufacturer, right, for the export-oriented operations. The acquisition was approved by the board exclusively with a view to subsequent disposal of the entire shareholding as part of the short-term capital optimization strategy. Normally, you don't acquire subsidiaries exclusively with a view to resale, right? So, but in this situation, as a strategic initiative, as a part of short-term capital optimization strategy of the board, so they have acquired a subsidiary, which is 100% ownership of a subsidiary exclusively with a view to subsequent disposal. It's mentioned, clearly mentioned at the time of acquisition itself. So this acquisition was approved by the board exclusively with the view of subsequent disposal. So the board commitment, board decision has been made to dispose this subsidiary at the time of acquisition itself. Okay. The board determined that 𝐒𝐫𝐽𝐷 valuation was temporarily elevated due to defense sector demand, and that long-term ownership would expose VGP to heightened regulatory and export control risk. Now, why they want to dispose this fast is actually the business that they are in, right? So relating to the what? Defense sector. So at the moment, there's a demand, but keeping that for long term, this particular subsidiary would cause regulatory burden. There would be regulatory impact when you are into the defense sector. So not to have that risk. So the board, what board wants is, as a short-term strategy of optimizing the capital, you acquire the subsidiary today, maybe to sell at a profit in the near future, right? So that's what they did. Then immediately upon the acquisition of this subsidiary, 100% equity stake, a binding sell mandate was issued to an international investment bank. Okay, so you have already signed a binding sale mandate, which was issued to an international investment bank. Formal, that means you are committed to sell. You don't have any doubts. So the particular sale mandate is a binding sale mandate. Then formal non-integration directive was approved prohibiting shared services, procurement, system integration or personal secondments. So you don't want to integrate this subsidiary that you're going to dispose with the other parts of the group. So that's why there are no integration. Now, for example, let's say if you have shared service, the services of that particular shared service center would be shared across the group. But here there's no integration. between the other group companies and this particular subsidiary that you are talking about. And also you don't do any personal secondments from this subsidiary or to this subsidiary, right? No system integrations. So because you don't want to integrate the operations of the other sectors of the group with this, because you will be disposing this subsidiary in the near future, right? So all these things suggest that board has the commitment, expectation and willingness to sell this subsidiary in the near future. Management was instructed not to initiate any new product lines or long-term contracts that could alter the buyer profile. And also management was instructed, don't do any new things, don't introduce new products, don't enter into long-term contracts, because what will happen is the buyer might not accept that. Buyer doesn't want to take this into account because you are going to sell the subsidiary, sell as it is without making any alteration. Right, then the numbers are given. And it was mentioned earlier, what was the consideration to acquire 100% stake of this subsidiary, AeroGrid, 2.4 billion. So here, at the acquisition date, fair value of AeroGrid's identifiable net assets amounted to rupees 1.9 billion. Now, when you acquire a subsidiary, what you do is you need to fair value the acquired subsidiary net asset. That would become the carrying value in the opening consolidated balance sheet. When you consolidate, you have to fair value all the identifiable asset and the identifiable liabilities of the subsidiary, take those values into the consolidated statement of financial position. Transaction cost were expensed as income. That's correct, no? If you incur any transaction cost in relation to the acquisition, you have to charge that transaction cost the P&L, right? You can't take that as a part of purchase consideration. No, you have to expense that. They have correctly done that. It seems that at the acquisition, there's a goodwill arose, right? Because why? As it's a 100% acquisition, no non-controlling interest, right? So the consideration is 2.4 billion rupees, where the value of the net assets are 1.9 billion rupees. So what is the goodwill? 0.5 billion rupees, or else 500 million. The sale agreement was subsequently signed with SkyPath Incorporation, a foreign buyer, with expected completion by 30th June 2025, subject only to regulatory clearance, right? So you found a buyer, right, called what? SkyPath. So it's a foreign buyer. You expect to complete the transaction by 30th June 2025, that is 3 months after the year end. But you have to get the regulatory clearance before you make the sale. You are selling to a foreign buyer as well as you are in the defense sector. So there are certain regulatory clearance that you need to take before you sell the company. This is the situation. It is mentioned, right? So then 31st March 2025, completion had been delayed by approximately 6 months, right? What has happened at the year end, you got to know, completion had been delayed, right? Initially, you were planning to dispose this by you were planning to complete the transaction disposal 30th June 2025. But now you expect a further delay of approximately how many months? How many months? 6 months. Another 6 months. It would get delayed due to a government initiated security audit triggered after the acquisition. Now what happened is you acquire this subsidiary on 1st October 2024. Then the year end is falling on 31st March 2025. That is 6 months from the date of acquisition. Then you initially plan to dispose this subsidiary by 30th June 2025. That is 3 months after the year end. Altogether from the acquisition, 9 months. But now it seems that it would be further delayed for another 6 months, means from 30th June 2025, it will be delayed up until when? 31st December 2025. That means if you look at the acquisition date, which is on 1st October 2024, how many months? 15 months, right? So that estimate of the date of completion of the sale has been changed at the year end by by extending that for another 6 months. Why? Due to government initiated security audit triggered after the acquisition. This is what? As it is defense sector, government wants to do a audit, right? So the parent company, acquirer, was now not aware about this particular audit, but this is something which has happened after the acquisition, and there is no control over the acquirer on this particular audit. Government has decided before giving the regulatory clearance, we need to initiate a security audit, right? The delay was outside VGP's control. That's why I said that it is outside the home parent entity. VGP's control, both parties remained committed and assets continued to be actively marketed. So basically both parties, in the sense both seller and the buyer, remain committed to complete this transaction. Unfortunately, something which is beyond the control of VGP has happened after the acquisition. That was actually happened at the year end because government wanted to do a security audit before you complete the sale. But still both parties are, if you look at the situation at the year end, both parties are committed for this particular transaction. Seller wants to sell, buyer wants to buy. Right. Then due to semiconductor shortage, 𝐒𝐿𝐺𝐠 fair value less cost to sell changed as follows. At acquisition, what is the fair value less cost to sell? 𝐒𝐿𝐺𝐠 means the acquiree, in this case the subsidiary. What is the fair value less cost to sell? At the date of acquisition, which is on 1st October 2024, right? 1st October 2024, 2.1 billion. Then 31st March 2025, 1.5 billion. So the fair value less cost to sell has come down, right? Okay. If I put a timeline of the event for your easy understanding, what happens? 1st October 2024 is the date of acquisition. This is the date of acquisition of this company, right? Then let's assume year end. So this is the financial year. Let's assume year end is on 31st March 2025. That is 6 months from the date of acquisition. So the initial expectation of making the sale was on when? 30th June. 30th June was the initial expected date of completion of the transaction. So that means from the year end, how many months? From the year end, how many months? 3 months. So altogether from the acquisition date, you expect at the acquisition date, from the acquisition date, this is actually in 9 months time. But what happened? At the year end, we got to know that government wanted to do a security audit. So the process would get delayed. It will take additional 6 months. So which means now the planned date of completion is extended for another 6 months. That is actually up until when? 31st December 2025. Right? This is another 6 months. So altogether from the acquisition, 6 months, 3 months and 6 months. 15 months time. Right? Okay. Right. So these are the information in the question. Now we need to answer. We read the requirement. So let's quickly look at it again. So the requirement in part A is assess the appropriate accounting treatment of 𝐒𝐿𝐺𝐠, including held for sale classification, measurement and impairment implications as at 31st March 2025 at the reporting date. First of all, what you need to talk about here is the relationship between the acquirer and acquiree, right? Acquirer is the company who is, now in this case, who is the acquirer? VGP, right? VGP is the acquirer. Okay, VGP is the acquirer. VGP acquired 100% equity shares of 𝐒𝐫𝐽𝐷. 𝐒𝐫𝐽𝐷 is the acquiree. Now, what is the relationship between the acquirer and acquiree? Control relationship, right? Because why? By acquiring 100% equity stake, VGP has the ability to direct the relevant activities of the investee. Investee means 𝐒𝐫𝐽𝐷. So, hope you can remember the definition of control. So, the definition of control has three elements. Power over the investee, that is the power to decide the relevant activities of the investee. Then expose the variable returns, which means if 𝐒𝐫𝐽𝐷 make profits, that is beneficial for VGP. If it makes losses, that's a cost to VGP. So you are entitled for the variable return, not fixed return. The third thing is ability to use the power to affect the investee's return. So these three conditions of the definition of control is satisfied. So then what is the relationship? Parent and subsidiary relationship. A person can have a doubt in their mind, okay, this particular subsidiary was acquired exclusively with a view to resell. So that whether the parent and subsidiary relationship is there, whether the control over the investee is there. So the definition of control is something different to the intention of making a sale. So whether the parent company has an intention to make a sale or not, if the control, so the three elements of control is established, that means parent company or the investor controls the investee. So you have to consider these two entities as parent and the subsidiary. So which means parent has to consolidate the subsidiary. So in the consolidated financial statements of VGP, you have to include the subsidiary 𝐒𝐫𝐽𝐷. Right? I hope you are clear about that. Okay, so these things we discuss in the theory. So just wanted to show you the place where we discuss these things. First of all, about the control definition. Over here, right? So elements of control, as per SL-FRS 10, there are three elements of control. Power over the investee, exposed to the variable return with the involvement of the investee, then investor has the ability to affect the return through its power over the investee. So the investor can, for example, investor can appoint the senior management of investee. So then investor can affect the return of the investee by using the power. So once these three things are satisfied, control is established. That means investor is the parent and investor is the subsidiary. That is clear. Thereafter, now the other standard what is discussed here is coming into play, that is SL-FRS 5, right? Non-current asset, held for sale and discontinued operation. There, this particular subsidiary is a special subsidiary. Why? Normally you don't acquire subsidiaries exclusively with a view to resell. But here you acquire the subsidiary exclusively with a view to resell. So if you look at the definition of non-current asset classified as held for sale, if you are expecting to recover carrying value of an asset principally through a sales transaction, we consider that as an asset held for sale. If you have a, let's say, forget about the subsidiary, if you have a property, if you expect to recover the carrying value principally through a sales transaction, that is what? There is no more to be accounted under LKS 16, property, plant and equipment. It has to be accounted under SL-FRS 5, non-current asset held for sale and discontinued operations standard. There are other criteria to be looked at, but the primary criteria is whether you are going to recover the carrying value principally through a sales transaction. Then that particular primary criteria is supported by two sub-criteria, that is whether the asset is available for immediate sale and whether the sale is highly probable. So if the asset is available for immediate sale and where the sale is highly probable, you say that, okay, you are going to recover the carrying value principally through a sales transaction, so that this has to be a non-current asset classified as held for sale. That is for single assets. Now here it is not a single asset. This is the entire subsidiary. So in case of this entire subsidiary, you are going to recover the carrying value principally through a sales transaction. Then what is that? That is a disposal group classified as held for sale. Why it is a disposal group classified as held for sale? Because it has group of assets plus associated liabilities. But it has to have at least one non-current asset. So it's a group of assets together with associated liabilities. You consider that as a disposal group, and you are going to recover the carrying value of this particular disposal group principally through a sales transaction. Then it is a what? Disposal group classified as held for sale. Yet again, to classify the disposal group as held for sale, the sale, so the two sub-criteria what I mentioned, it should available for immediate sale and sale should be highly probable. Then when it comes the sale is highly probable, there are few indicators that you need to look at and justify, yes, actually the sale is highly probable. So hope you can understand what I explained. Not rocket science, what we discussed in the classroom. Right, so I'll show you, I'm showing you the theory tude because you can revise your knowledge. If you can't remember the things what I explained, you have to go through the theory tudes and get to know about these areas because these are fundamental areas of the syllabus. So I'm not going to go through everything, right? But I'll show you in summary what I'm talking about. Right. Okay. The name of the stand is SL-25, non-current asset held for sale and discontinued operation. So in this standard, actually there are three things that we need to focus on. One is classification criteria of non-current asset held for sale. Then measurement requirement of non-current asset held for sale and presentation requirement of non-current asset held for sale. So these are the three things that the question is about. Section A. Right? Classification, presentation, measurement. Measurement means recognizing impairment losses, maybe at the initial point, initial measurement or subsequent measurement. Right? So then this is what I mentioned. So the primary criteria of classifying something as held for sale is you need to recover the carrying value principally through a sales transaction. Then for you to say that this primary criteria is satisfied, there are two detailed criteria. One is the particular asset should be available for immediate sale. If a buyer comes today, you should be able to give it. And sale is highly probable, which means, what do you mean by the word probable means what? Probable means more likely than not. More likely than not means more than 50% chances there to happen something. This is not probable. This is what? Highly probable. Highly probable. High percentage of probability. Maybe 80% chance, 85% chance, 90% chance is there to happen the sale. So for you to see that whether the sale is highly probable, there are indicators given over here. Now, what are these indicators? Management committed to a plan to sell. In this case, board is committed to sell. Right? At the acquisition itself, they are committed. They wanted to sell. Active program to locate a buyer has been initiated. Yeah, that's why they have appointed an investment banker. Then actively marketing at a reasonable price. So now they already found a buyer. That means it should have been marketed at a reasonable price. Otherwise, buyer won't take it. Then significant changes to the plan are unlikely. The board won't reverse their decision. It is unlikely. And this is important. Sale is expected in 1 year from the date of classification as held for sale, may be extended in certain circumstances. Now, remember, I put the timeline. Normally, for you to say that sale is highly probable, it has to be, so the sale has to happen from 1 year time after classifying as held for sale. Now, in this case, you acquire the subsidiary on 1st October 2024. So from that date, because from that date onwards, from that date itself, you classify this as held for sale. Because from the acquisition itself, board wanted to sell this. So the sale should be completed within 12 months from that particular date. Now, but there's something happened at the year end where, because initially you were expecting to complete the sale from the acquisition, because from the acquisition to the year end 6 months, then from the year end in 3 months time. Altogether, from the acquisition date, from the time of classification as held for sale, within 9 months you were expecting to complete the transaction. But what has happened? Something which is beyond your control has happened, right? Government wanted to conduct an audit. Because of that, it would be further delayed for 6 months. Now, if you look at the total period from the date of acquisition, from the date of initially classifying as held for sale, it would be more than 12 months. Then you have a doubt, okay, whether this particular criteria is satisfied. But here it's mentioned that may be extended in certain circumstances. We have to look at what do you mean by these certain circumstances. That is also there, right? So this is what I mentioned, that this is not a single asset disposal group of assets. It should have at least one non-current asset within the scope of SL-25 plus directly associated liabilities. It is a disposal group. In this case, the subsidiary is a disposal group. You are trying to recover the carrying value principally through a sales transaction. That's why I mentioned that this is a disposal group held for sale, right? Then this is an important point. What is that? It's clearly mentioned. Now in this case, what happened is the period is extended for more than a year from the initial classification as held for sale, right? It will go more than 12 months. So the standard allows you to take that into account and say that, to conclude that it is still highly probable if the delay, okay, if the delay is caused by an event which is beyond entity's control. In this case, government starting the audit is not within the control of anyone, right? It is beyond the control of the parent company. And also, board is still committed to sell. There's a delay which is because of an event which is outside the control of the parent company, but still the parent company committed to sell. So in that case, even though it goes beyond 12 months from the initial classification as held for sale, doesn't matter. You can continue to classify this as disposal group classified as held for sale. I hope you are clear about it. Again, I don't have time to explain all this theory. So if you can't remember the stuff, you have to go and watch the videos, revise your knowledge on theory parts. Does not preclude an asset or a disposal group from being classified as held for sale if the delay is caused by an event and circumstances beyond entity's control and sufficient evidence exists that entity remains committed to its plan to sell. Okay? Right. I hope you are clear about it. Okay. Then moving back. Now we need to work on the numbers, right? We need to work on numbers. Which means, what do you mean by work on numbers? Because it's clearly mentioned, you have to explain the classification, measurement and the presentation requirements along with any computations which are required. Now in this case, first of all, on 1st October 2024, VGP is acquiring 100% equity holding of a subsidiary 𝐒𝐿. Now you establish the control, so the parent and subsidiary relationship is there. Consideration is 2.4 billion. So then what you do is you need to calculate the goodwill on acquisition. So what is the goodwill on acquisition? For that, you have been given the information about the fair value of the identifiable net asset at acquisition. What is the fair value of identifiable net asset at acquisition? 1.9 billion. So this is a 100% acquisition, so which means there are no non-controlling interest. So that what would be the goodwill? What would be the goodwill? You can say goodwill purchase consideration, I'll say PC means purchase consideration, 2.4 billion rupees Then fair value of net asset. Fair value of net asset of the identifiable net. Fair value of identifiable net asset of the acquired subsidiary at the acquisition date 1.9 billion. So what is the goodwill? Purchase consideration minus fair value of identifiable net asset of the subsidiary 0.5 billion is the amount of the goodwill that you recognized as at the date of acquisition, which is on 1st October 2024. From this date onwards, you are consolidating the subsidiary. Right? Okay. Then in my opening consolidated statement of financial position in relation to this particular subsidiary, what is getting recorded? What is getting recorded? In my opening consolidated statement of financial position in relation to this subsidiary, what is getting recorded? In my consolidated statement of financial position. So in my consolidated statement of financial position, what do I have in terms of this subsidiary? So you are doing the line by line addition of the assets and the liabilities. So what is the net amount? So you take the fair value and value of these assets and the liabilities, and you get them added to your you are getting that added to your consolidated statement of financial position. So for the time being, think about it is happening in line by line addition. So I'll come to the important point of not doing the line by line addition in relation to this situation in a little while, but just assume for the time being, okay, you are doing the line by line addition. If you do the line by line addition, what will happen? You are adding all the assets, all the liabilities at their fair value. Ultimately, what is the net assets that you are taking into the opening consolidated statement of financial position? You are taking net assets, which is assets minus the liabilities. How much? 1.9 million. In addition to that, you take a goodwill figure of 0.5 million. Right? Because in terms of this particular subsidiary, what you have in my consolidated statement of financial position is 1.9 million of assets minus liabilities, net assets, plus 0.5 million of goodwill. Right. I told you this standard needs us to explain 3 requirements. Classification requirements, now we have already discussed. Okay. When to classify an asset or a disposal group as held for sale, now we discussed complete. Then what? Measurement. I'll come to the presentation. That's why I mentioned that later on I'll discuss whether we are going to do the line by line addition or not in terms of the assets and the liabilities. So that is presentation requirement. Before that, let me explain the measurement requirement. What are the measurement requirements which are specified in SL-FRS 5? What it says? At the date of initial measurement of an asset or a disposal group as held for sale, which is on when? The acquisition date of the subsidiary, 1st October 2024. You need to look at 2 values. Out of that, you need to take the lower value as the measurement basis. So what are these 2 values? One is, what is the carrying value of the assets and the liabilities, including the goodwill figure. So if it is a single asset, very simple, carrying value of the asset. And the other value is fair value less cost of sale. You have to consider these 2, carrying value of the asset and the fair value less cost of sale of the asset. Out of that, lower value is the initial measurement what is prescribed in SL-FRS 5. If it is a single asset, very simple, carrying value of the asset, then the fair value less cost of sale of the asset. Out of these 2, which one is lower? In this case, it's a disposal group, so that carrying value means in my consolidated statement of financial position, on behalf of this subsidiary, what do I have now? I have net asset value, assets minus liabilities 1.9, plus I have goodwill of 0.5 million. That means altogether, how much that I do have in this situation with regard to this subsidiary in my consolidated statement of financial position, 2.4 million, this is the carrying value. Right? In other words, in my consolidated statement of financial position, on behalf of this subsidiary, what do I have? I have net assets and I have goodwill. So the total carrying value of 2.4 million. Then in the question, you have been given, on the acquisition date on 1st October 2024, what is the fair value less cost to sell? You have been given that information. Right? Here, arrow grids, fair value less cost to sell, changed as follows. At acquisition, 2.1 billion. Now, carrying value is how much? 2.4 billion. Right? Carrying value is 2.4 billion. On the other hand, fair value less cost to sell. I am doing this on this particular data, 1st October 2024. Fair value less cost to sell. Fair value less cost to sell. 2.1. Now, out of these two, which figure is lower? 2.4 or 2.1? 2.1 is the lower figure. You compare the carrying value and the fair value less cost to sell. Out of that, take whichever lower. What is lower? Fair value less cost to sell is lower. Then what do? You have to bring down the value up to the fair value less cost to sell. So that means you have to recognize an impairment loss of how much? For the difference. What is the difference? 2.4 minus 2.1. You have to recognize an impairment loss of 0.3 billion. Okay, you have recognized an impairment loss of 0.3 billion. Are we clear? That is the initial measurement. On the date of classifying an asset or a disposal group as held for sale, you have to compare the carrying value and fair value less cost to sell, take whichever is lower. Who says? Accounting standard. Again, if you have forgotten what you have learned, I'll show you. SL-25 5. So, here. Look at this. I'm not going to go through again everything. Measurement. Measurement on classification. Measurement on classification. Asset, it can be a single asset or a disposal group within the measurement scope of SL-25 5. Lower of carrying amount, in this case carrying amount is how much? 2.4 billion. Fair value less cost to sell, which is 2.1 billion. So what is lower? 2.1 billion is lower, so that you have to recognize an impairment loss of 0.3 billion. Then, how do we book the impairment loss? Normally, if it is a single asset, very simple, you credit the asset account and debit to the P&L. If it is an asset. But here it's not an asset. It is a what? Disposal group, which has number of assets. Right? Plus, there's a goodwill figure as well. In this particular disposal group, you have assets minus liabilities. Carrying value is 1.9 billion. Now for the consolidation purpose, and goodwill, which has a carrying value of 0.5 billion. So it has number of assets. Now, when you want to book a impairment loss of 0.3 billion, where do you charge this? The debit entry obviously goes to the P&L. Impairment loss means P&L debit. Where to credit? Which asset you should credit? So the order of allocation of the impairment loss has to be as per LKS 36 impairment of asset standard. You refer another standard. Okay, so the name of LKS 36 is impairment of assets. That particular standard explains us when you recognize an impairment loss for a cash generating unit, what is the order of allocation? What is the order of allocation? First of all, you allocate to the goodwill, right? Thereafter to the other assets on pro rata basis. In this case, 0.3 billion, first of all, you need to allocate to the goodwill. What is the goodwill figure? 0.5 billion. So out of 0.5 billion, you impair 0.3 billion. So that the goodwill value because of the initial impairment loss will come down from 0.5 billion to 0.2 billion because you have recognized an impairment loss of 0.3 billion. You charge 0.3 billion to the P&L, credit entry goes to the goodwill, right? Credit entry goes to the goodwill. Because what is the carrying value of goodwill? What is the carrying value of goodwill? 0.5 billion. So out of that, you need to deduct how much? 0.3 billion. So then the carrying value of the goodwill would become 0.2 billion. Right? Then what do you have as the carrying value? Net assets 1.9 billion plus goodwill of 0.2 billion, which is equal to the fair value less cost to sell, which is equal to the what? Fair value less cost to sell. Asset initial measurement under SL-25 non-current asset held for sale. It is 2.1 billion. Let's assume not in this situation, if the fair value less cost to sell is higher than the carrying value. Now, what is the carrying value? Net assets plus goodwill 2.4 billion. Let's assume, for your information, fair value less cost to sell is 2.6 billion. Then what do? Again, you apply the same logic. Lower of carrying value. What is the carrying value? 2.4 billion. Lower of carrying value or fair value less cost to sell. Fair value less cost to sell is how much? 2.6 billion. In that case, at what value I should initially measure this particular disposal group under SL-25 carrying value, because carrying value is lower, 2.4 billion. Then the value is 2.4 billion, which means no impairment. You don't recognize any impairment gains. You can reverse the previous recognized losses, but there's nothing called impairment gains. Okay, so the carrying value is lower. I hope you are clear, right, on what I explained. Right. So if I show you, this is the suggested solution. So actually I explained more than what is there in the answer for your understanding of the matter, right? If I just show you the numbers. So this is what I mentioned. Under the acquisition accounting, at the time of acquisition, you recognize a goodwill amount of how much? 0.5 billion. Purchase consideration 2.4 billion minus value of the subsidiaries identifiable net assets 1.9 billion. You recognize a goodwill figure of how much? 0.5 billion. Okay, then immediately upon classification as held for sale, disposal group is measured at what? Lower of carrying amount of fair value less cost of sale. So in that case, we looked at carrying value of the disposal group, including the goodwill 2.4 billion, fair value less cost of sale at acquisition 2.1 billion, which is lower fair value less cost of sale, which means you have recognized an impairment loss on initial classification, 1st October 2024. On initial classification, 0.3 billion, and I told you, you first of all allocate that to the goodwill. Are we clear? That is the initial measurement under SL-25. Now we discussed classification requirements of SL-25. We discussed initial measurement requirements under SL-25 and recognized an impairment loss. Now what are we going to look at is subsequent measurement under SL-25. Subsequent measurement means that at the year end. Now the year end is falling on 31st March 2025. Okay, year end is falling on 31st March 2025. At the year end, now you need to apply SL-25 and the subsequent measurement of SL-25 is at fair value less cost of sale. There you don't talk about the carrying value or fair value less cost of sale, which is lower, that is not applicable. That is applicable only at the initial measurement. At the year end, at the subsequent measurement stage, what you looking at is the fair value less cost of sale. Subsequent measurement of a non-current asset or a disposal group classified as held for sale is at fair value less cost of sale. So how much is the fair value less cost of sale at the year end? Again, that information is given in the question. Fair value less cost to sell as at 31st March 2025 has further come down to what? 1.5 billion. Now, after recognizing an impairment loss on goodwill at the initial measurement, the value of the disposal group has come down to 2.1 billion. Now, at the year end, fair value less cost to sell is how much? 1.5 billion. So, which means what you do? You have recognized and further impairment loss of how much? 0.6 billion. The difference between 2.1 billion and 1.5 billion. You have recognized the impairment loss of how much? 0.6 billion. Are we clear? Then the question is, where should I allocate that 0.6 billion? Because if it is a single asset, yet again, P&L debit, particular asset credit. But this is a what? Disposal group, right? It has multiple assets, including goodwill. So, follow the allocation order of LKS 36, impairment of assets standard. Where do we allocate first? To the goodwill. But out of goodwill, now what is the remainder? After you allocate the initial impairment loss of how much? 0.3 billion. Now the remaining value of the goodwill is only 0.2 billion. But under the subsequent measurement under IFRS or SLFRS 5, local version is SLFRS 5, you need to recognize a total impairment loss of 0.6 billion as at 31st March 2025. Out of that 0.6 billion, how much you can allocate to the goodwill is only 0.2 billion because the carrying value of the goodwill is only 0.2 billion. Then remainder means how much? 0.6 billion minus 0.2 billion. So what is the remainder? Remaining 0.4 billion, where do you need to allocate is to the other assets of the cash generating unit. In this case, other assets of the disposal group. On what basis? Pro rata basis, proportionate basis. You need to allocate, right? So you should know that we don't have the information here. If we know with regard to that particular subsidiary, what are the assets which are there in the consolidated statement of financial position, and allocate the impairment loss, remaining impairment loss of 0.4 billion on pro rata basis. But when you are doing the pro rata basis allocation, you need to be careful on one thing, that is, there can be certain assets, right? Within that disposal group, there can be certain assets where you can individually determine their recoverable value. Now, for example, let's say there's a particular land. That particular land is very valuable land. We know for sure that, now let's assume there's a particular land within this disposal group where the carrying value of that land is about 0.7 billion, right? And you know for sure that this can be sold at a price which is above the 0.7 billion. Let's say the market value of that land is 1 billion, where the carrying value is 0.7 billion, where you know the market value of this land is 1 billion. Then in that situation, is there any way where we can allocate pro rata basis losses to that particular land? Because if you allocate pro rata basis losses to that particular land value will further come down. 0.7 billion minus the allocation. Where the market value of the land, we know for sure 1 billion. So what the standard says is, when you are doing the allocation, look at whether there are any individual assets where you can measure either their fair value less cost to sell or else their value in use. Look at these numbers. If these numbers are given which are above the carrying value, don't allocate any pro rata basis losses to these assets. And also, maximum allocation has to be up until the zero. You can't allocate, you can't make any allocations to make the negative asset values. Okay, when you are doing the pro rata basis allocation, this is there in the answer as well. I'll show you. When you are doing the pro rata basis allocation, you need to be careful. Read this part. Again, pure theory. Yeah? If you look at LKS 36, I'm not going to show you the standard. So this information is there. What it says, in accordance with SLFRS 5, any impairment loss arising on measurement on disposal group at lower of carrying amount and fair value less cost to sell is allocated first to reduce the carrying amount of the goodwill. That's what we did. And thereafter to the other assets on the disposal group on pro rata basis based on their carrying amount. However, no asset is reduced below the highest of its individual fair value less cost to sell. Its value in use and zero. You can't make the allocation to make the asset value negative. So there can be individual asset where the examiner gives you this is the value, fair value less cost to sell, or this is the value in use of this asset. So in that case, the maximum allocation that you can do is up to that amount. In my example, you can't do any allocation to the land because why? Value of the land is 1 billion where the existing carrying value is 0.7 billion. You can't make any allocation. There can be another example. Let's say there's an intangible asset, patent. It is very valuable, right? So the value is very high, but the carrying value is less. Examiner has given you this is the value of this patent, kind of an intangible asset. Then can you do the pro rata basis allocation? You can't because carrying value is small, fair value is very high, right? So if you allocate it, you are reducing the value unnecessarily where that particular asset individually has a market or individually it has a value. That's why I mentioned based on their carrying amount. However, no asset is reduced below the highest of. If you are given the fair value less cost to sell, value in use of these individual assets, be careful when you are doing the pro rata basis allocation. Right. So I explained, right, the numbers I have explained. So, okay, for your knowledge, now what happened? Initial measurement with regard to this disposal group classified as held for sale on 1st October 2024 was 2.1 billion. So where the carrying value was 2.4 billion and we recognized the impairment loss of 0.3 billion. Then as a subsequent measurement, 31st March 2025, fair value less cost to sell is 1.5 billion. So you have to recognize a further impairment loss of how much? 0.6 billion. And we discussed how to allocate that particular loss, 0.6 billion as well, 0.2 billion to the goodwill and 0.4 billion to the other asset on pro rata basis. But remember the restriction what I have mentioned. Okay, if you are given the fair value less cost to sell, value in use of a particular asset, don't allocate more than that. And also don't make the asset values negative. So the maximum value is 0. Right? For your knowledge again, let's assume at the year end, not a part of the question for your knowledge, right? 31st March 2025, fair value less cost to sell is not 1.5 billion. Let's assume this is 2.5 billion. It has gone up. It was 2.1, this is 2.5 now. What is the measurement? Subsequent measurement? I told you fair value less cost to sell. You have to measure this at fair value less cost to sell. There in the subsequent measurement, you don't consider the carrying value. Only for the initial measurement, you take the lower of carrying value and fair value less cost to sell. Subsequent measurement is at fair value less cost to sell, which is how much? 2.5 billion. Then, if you do that, if you measure it at 2.5 billion, from 2.1 billion to 2.5 billion, what is the increase in value? 0.4 billion. 0.4 billion. Can you pass an entry like this? Credit P&L 0.4 billion. If you credit P&L 0.4 billion, what do? You recognize impairment gains. You can't recognize impairment gains. Maximum what you can do is you can reverse the impairment loss. What is the impairment loss that you have already recognized? 0.3 billion. At the initial measurement, you recognize an impairment loss of how much? 0.3 billion. So that even though the fair value less cost to sell has increased by 0.4 billion, you can't reverse 0.4 billion. Maximum what you can reverse is how much? Maximum what you can reverse is 0.3 billion. So when you reverse 0.3 billion, what will happen? The carrying value of the asset would be, because initial measurement, it was 2.1. Then you reverse 0.3 billion. What's the double entry? P&L credit 0.3 billion and this carrying value is getting added 0.3 billion. So what would be the year-end carrying value? 2.4 billion. But year-end fair value less cost sale, 2.5 billion. So can you have that type of situation? Possible. Because why? If you recognize 0.4 million, what will happen? In addition to the reversal of impairment losses, you are recognizing impairment gains as well. That is not possible. So it is actually a reversal of impairment loss. Reversal of impairment loss should be limited to the maximum impairment loss what you have already recognized. That is additional information for your knowledge, right? So with that, I think I explained more than enough. The rest what you can actually go through. So the suggested solution, answer, I have explained the important aspects, right? Yeah, that's it, I explained. Yeah. If you want, we can quickly go through as well for the completeness, right? So what it says, let's quickly go through. Now the entire thing, approach note. Identify whether 𝐒𝐫𝐚𝐽 meets held for sale criteria at acquisition and at reporting date. Then apply measurement at lower of carried amount of the disposal group and fair value less cost of sale, recognizing impairment where applicable. Finally, conclude about the presentation implications, right? Okay, I have not discussed the presentation implications. I'll come there, right? So I told you there are three things SLFRS 5 is looking at. One is classification requirements, then measurement requirements. In measurement requirement has two things. Initial measurement, in this particular example, 1st October 2024, and the subsequent measurement that is at the year end, 31st March 2025. So now we looked at initial measurement requirements as well as subsequent measurement requirements. Right, I'll come to the presentation now. Classification held for sale as at 31st March 2025. That is at the year end. VGP obtains control over 𝐒𝐫𝐚𝐽 at acquisition through 100% equity ownership and exposure to variable returns. Okay. Board's intention to dispose the subsidiary doesn't affect the control assessment as consolidation is determined by the existence of control, not management's disposal intentions. Accordingly, 𝐒𝐫𝐚𝐽 must consolidate. 𝐒𝐫𝐚𝐽 must be consolidated from acquisition date and goodwill recognized in accordance with SLFRS 3. I told you control relationship is established so that parent and subsidiary relationship is there. If so, you need to consolidate the subsidiary where you need to calculate the goodwill at the rate of acquisition, which is on 1st October 2024. At acquisition, board's documented plan and binding sell mandate indicate immediate commitment to sell and that disposal is highly probable. I explained, right? So the asset should be available for immediate sale and the sale should be highly probable. Why it is highly probable? We looked at the criteria as well, because in this situation you identify the buyer, sale agreement is signed, so you expect to complete the sale within 12 months at the rate of classification as held for sale. Initially, 1st October 2024, you want to complete the sale within 12 months from the date of classification. At the year end, although the completion is delayed, delay is caused by events outside VGP's control. Government audit initiated after the acquisition and VGP remains committed. So active marketing and continued pursuit of selling the particular company. Therefore, held for sale classification continues as at 31st March 2025 as I told you. Because of an event that is outside the control of VGP, you can't complete the sale within 1 year from the date of classification as held for sale, that is from the initial date, 1st October 2025, but doesn't matter, the standard allows you to keep that classified as held for sale if two conditions are met, that is Why you couldn't make the sale is because there's an event which is taken place beyond your control. You are still committed to sell, so that you can continue to classify this as held for sale as at the year end as well, which is on 31st March 2025. Right. Although consolidated, Arrowgrid continues a disposal group classified as held for sale under SL-25 5. Right. Now I am going to explain you the presentation requirement. Normally, how do you consolidate a subsidiary? Very simple, no? Line by line addition. Parents assets plus subsidiary assets added. Parents liabilities plus subsidiary liabilities added. If that is a normal subsidiary. But this one is not a normal subsidiary. This is a subsidiary acquired exclusively with a view to resale. So when you are making the presentation in the consolidated financial statements, you do a special presentation, which means what? You don't consolidate the individual asset by asset of this particular subsidiary, liability by liability of this particular subsidiary. What do you do is you still consolidate, but by following a different basis. What is that? Without doing the line by line addition, you take all the assets of this subsidiary, take the aggregate value of all assets of this subsidiary, and that aggregate value you present as a one line item under the current assets of the consolidated statement of financial position. Okay? Did you understand? You don't do the line by line addition for the assets and the liabilities of this subsidiary. Instead of that, what do? You take the total asset value of this subsidiary, aggregate that and show as a single line item in the consolidated statement of financial position under the current assets. You can name that particular line item as assets of the disposal group classified as held for sale. Similarly, liabilities, you don't do the line by line addition, right? You take the aggregate value of all the liabilities of this particular subsidiary, which you classify as held for sale. That aggregate value you present as a single line item in the consolidated statement of financial position under the current liabilities. Liabilities of the disposal group classified as held for sale, and you put the total. So what do? You take the assets and the liabilities of the subsidiary to the consolidated statement of financial position, but by following a different basis, which means you don't do the line by line addition. All assets, club them together and show as a single line item under the current assets. All liabilities, club them together and show as a one line item under the current liabilities. And you can give a note, because on the face normally you show the aggregate value, then you give a note explaining the breakup of that aggregate value of the assets and the aggregate value of the liabilities. I hope you are clear with that. Right? That's why I mentioned that when I was discussing even the value of the net assets are same. Assets minus the liabilities are the net assets. No, that's why I mentioned that at the initial point, assume that you are doing the line by line addition. Actually, in this case, you don't do the line by line addition. But the value, assets minus the liabilities, the ultimate value is same. Carrying value of the assets minus the carrying value of the liabilities, which are the net assets, are same, but a different presentation. Right. I hope you are clear. Its assets and the liabilities are therefore presented separately in the consolidated statement of financial position. Okay. I have explained more than this. Then measurement we have looked at, right? We have looked at this, and even allocation order we have gone through, right? And even the numbers we have worked out. You can go through that part. Okay, so that is the answer to the part A. Okay, part A. Part A of the question number 1. Part A of the question number 1, right? So we have answered now. See whether we have answered. assess the appropriate accounting treatment for arrow grid, including held for sale classification, measurement, initial and the subsequent measurement, and impairment implications. Because of the subsequent measurement, there are impairment implications, right? Impairment losses that you recognize as at 31st March 2025, right? Actually, in this question, presentation was not tested or not specifically asked, but I have explained you the presentation requirements as well as even in the suggested solution, they have given that in very brief how to present. Not to do the line by line addition, but to include as a one line item of the aggregate value of the assets under the current asset as assets of the disposal group classified as held for sale. Liabilities also as a one line item under the current liabilities, the aggregate value. Liabilities associated with the assets of the disposal group classified as held for sale, or else liabilities of the disposal group classified as held for sale. Right, so how many marks? 10 marks. Now you see the time management. Now for all these things in the exam, what's the time that we need to spend? 1.8 minutes per mark. That means we have to complete entire thing. Read the question, plan the answer, put that into the answer format and do the computation. Everything has to be completed within 18 minutes. That is the challenge in the examination. It is time bound. So you have to be thorough with the theory, because you can't, basically theory has to be there in your fingertips to answer this type of question. Now you know the theory, this is a very simple and straightforward question. No complications at all. So the exam is not difficult. But if you don't know the theory, you can't answer. Right? How many standards got involved here? Control definition, SL-FRS 3. Non-current asset held for sale and discontinued operation, SL-FRS 5. Then the allocation order of impairment loss, LKS 36, impairment of asset standard. Then the question has multiple requirements and you have to do the computations. So that's why what you do is you have to write and practice. Now what you do is this particular question, now after you watch the video, you write it by yourself again, the answer, before you re-watch the video. If you want, you can re-watch any number of times, you can watch. But what I'm telling is, you at least write by yourself one question per day up until the examination, because you have to write and practice. Then only you will be able to manage the time in the examination. Otherwise, you have the knowledge, but still you can't compile the answer within the time frame available in the examination. So this is a good question for you to practice that. Right? Okay, so that is part A of the question number 1 for this pilot paper issued by CASriLanka for June 2026 examination.